After having the best month in stocks since 2020 in January, and after having triggered a golden cross in the S&P 500 on February 2nd, the rest of February saw a broad-based decline across equity and bond markets. The market's pullback started pre-open on Friday, February 3rd, with the BLS jobs report being better than expected, better than any economic bull could have imagined. Based on the market seasonals, it shouldn't come as a big surprise that equities struggled in February after a strong January. I'm Chris Perras, Chief Investment Officer with Oak Harvest Financial Group. This is our investment team's midweek release called News or Noise. This week, we do a little February recap and title it February Made Me Shiver. Going into early February, our investment team messaged that seasonally speaking, we are entering what was historically a short-term rough patch. Statistically speaking, February has been the second worst month for stock returns, with only September's average return being worse. Dating back to 1929, February has been positive only 53% of the time, and the average return for the month is marginally negative. Only September has a worse track record for monthly returns, with a negative return profile nearing 1.2% and positive returns less than 45% of the time. As one might have expected, the greater than normal rally in the markets in January gave way to a larger than seasonally normal decline in February. The S&P 500 was up almost 6.2% in January and declined about 2.6% in price during February. The only positive returning groups for February remained 2022 laggards: consumer discretionary, technology, and industrial stocks. The worst groups in February, energy, utilities, and healthcare, were the worst performing groups in January and the best performing groups in 2022. What can we point to as a catalyst for the February stock pullback and a rise in short-term yields? Well, that's easy after the fact. A still strong U.S. consumer spending post-Christmas and a strong labor market for services gave rise to an uptick in inflation expectations. This caused nominal interest rates to rise, causing a stronger U.S. dollar. As discussed throughout much of 2022, a stronger U.S. dollar is a headwind to revenue and earnings growth for many large-cap U.S.-based multinational stocks that weigh heavily in the S&P 500. This dynamic hit at the same time the manufacturing data like the Philly Fed Index, Chicago PMI, and other regional manufacturing data points are pointing to a contraction. The good news is that February stock declines combined with rising interest rates have now extended themselves, both in price and time, to levels that should again support forward returns positively in coming months. Investors recall that March through July tend to be stronger returning months for stocks, particularly in the third year of a presidential cycle like this year, 2023. Take a look at the historical data by Merrill Lynch. Looking at the last 70 plus years, stocks have had a positive one-year return after midterm elections every single cycle, averaging almost 15% over the next 12 months. That is news for your money. Of course, there are no guarantees in the stock markets and every cycle is different, but those are pretty good odds in my book. If February in the stock and bond markets made you shiver, get on the phone and give our team of financial advisors and planners a call. We will sit down with you and help you and your family do the math to figure out how you might meet your retirement goals. Our team specializes in tailoring broad investment portfolios to meet your needs and maybe a few of your greeds in retirement. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. I'm Chris Perras, and from the whole team here at Oak Harvest, have a blessed week.